LTIMindtree. It is one of the top Nifty gainers after reporting what was an inline set of numbers for Q2. Revenue came in line with estimates while margin did shrink due to a wage hike. In fact, Reema caught up with Nachiket Deshpande, who's the COO at the company, to discuss their Q2 numbers. Let's listen in.
You're in the final stages of closure, which will close in Q3. Now, deal wins for you for the last 4 quarters have been flattish. Many of your peers have reported a big pickup in deal wins. What's the likely deal win run rate for you going ahead? Will it be similar to 1.2, 1.3, 1.4 that you've been seeing, or will there be a significant pickup going ahead?
So I think if you look at, while we may not have reported as many deal wins as some of our peers have, doesn't mean that we didn't have the deal closures, right? It's just that, the type of that we report, the customers that are comfortable for us to report those deals, there are differences and hence the different strategy adopted by each of us. But as you see in our order inflow numbers, we've been steadily having healthy order inflows for last quarter as well as this quarter. And that's really how it reflects going forward as well. We don't expect any spike in that, but we expect that we'll continue to have the steady build out of that order inflow as well as more deals come close. Also, of course, the deals that are there now, more number of deals are cost takeout, cost efficiency, consolidation oriented, right? Which will mean that they tend to be more, longer tenure deals than the transformation deals, and that. From that sense, you will see an increase in the TCV and you might see increase in the order inflow accordingly. But I don't think we're not expecting to see a significant spike there. It's probably going to be an incremental addition to that. And we're comfortable with that numbers. It's giving us good visibility in terms of how the revenue buildup will happen in subsequent quarters.
What's the average tenure of the deals versus before?
So I think the average tenure of the deal per se hasn't changed. I think we continue to have 3 to 5 year deals, which are in the vendor consolidation or managed services type of space. It's just that the number of deals of such category in our pipeline is more. So higher number of deals are of this type than the transformation type in the past, and hence we don't calculate that number, but hence I think you would see that on an average, our deal tenures would have gone higher because of the mix of the deals in our pipeline.
You have also guided for Q4 exit margins, that's Q4 FY24 margins, to be about 17 to 18%. How have you arrived at that math? What's baked into it?
So the 72, I think we guided for that even in the beginning of the year, that we said as a combined company, we will exit with the margin that we were used to deliver as we go through our integration and the bulk, the initial cost increase because of integration activity as it goes away. And we're confident of that. We had budgeted for the wage increase that we gave in this quarter as a part of that plan. So we knew that this quarter will have an impact on the margin as we take the wage hike impact. But our margin optimization initiative that we launched post the merger is delivering us results and is expected to deliver all of its savings in Q3, Q4. We've also managed to take utilization to 86% plus, and we are confident that we'll be able to maintain at that utilization. So with our productivity and margin improvement initiatives kicking in and our utilization being maintained at that 86% level, I think we feel confident that with the growth that is there for us in H2, we would be able to exit the year with the EBIT margin in that 17 to 18% range.
Just one final question. By the end of FY24, what would be the extent of cost synergies you would have extracted?
So the cost synergies, as we said, primarily will actually come back-ended because the optimization because of integration, which is whether it is in our G&A components or whether it is in our real estate or any of those will be back-ended. Those have not come in now. We have started those initiatives, but as you can imagine, there are existing leases and existing commitments, so it will take time as we consolidate facilities and those earlier facilities wind down. So the margin synergy because of merger is expected to come in towards the latter part of our 5-year period that we had already guided for. What is coming in today is some scale benefit. So utilization improvement is essentially scale benefit. I would not call it a merger benefit, but it is a scale benefit. Now, instead of a 45 or 50,000 people organizations that we are now a 85,000 people organization, and hence our ability to optimize our bench is much better. And hence we are able to operate at a couple of percentage point better utilization that we would have been able to. So those synergies have come in. But the real synergies due to merger, which are part of our plan, will come in back-ended. That's where we had said over a long term, we expect a 200 basis point improvement in our overall margin levels towards the end of that. That is driven largely by the merger synergies.
Got it. Thank you.
Okay, that's the word coming from LTIMindtree. The stock is higher by 5.5% in today's trading session. We'll slip into a short break now. Umesh Chaudhary from